Nvidia just more than doubled profit to $59.6 billion in a single quarter. That record quarter is now driving almost every dollar of AI infrastructure spending, from chips to gigawatts of new data centers, with Nvidia's sales at the center of it. Can that 70% growth actually be delivered when supply is tight and Nvidia itself is guaranteeing customer financing to buy the chips? Fiscal second quarter 2027 ended July 26th. Revenue was $96.2 billion, verified as $96.221 billion, up about 106% from $46.743 billion a year earlier. Profit was $59.6 billion, reported as $59.688 billion, up about 126% from $26.42 billion, both more than doubled year over year. The beat was not narrow. Revenue came in about $4 billion above consensus. Adjusted earnings were $2.22 against about $2.08 to $2.10 expected. Data center was $89 billion against about $85 billion expected, and guidance for the current third quarter, $108 billion plus or minus 2%, also topped expectations. It is the 15th consecutive quarter beating Wall Street on record revenue, even as the size of those beats has been narrowing. Data center was $89 billion, up 117% and more than 92% of total sales. Hyperscale was about $48.7 billion, up 102%. AI cloud, industrial, and enterprise was about $40.3 billion, up 138% and growing faster sequentially than hyperscale. Chief Financial Officer Colette Kress framed next fiscal year, fiscal 2028 ending January or February 2028, described as 70% growth in 2027 at about 70%. That is up from about 44 to 45% previously expected. It is a supply-constrained outlook, not a demand ceiling. Customer forecasts implied demand could roughly double, around 100% growth, but memory and high-bandwidth memory, packaging and related supply limit what Nvidia can confidently deliver to about 70%. Management described compute as revenue now, tokens as productive and profitable. Two anchors support that 70%. Forward supply and capacity commitments jumped to $279 billion from $119 billion the prior quarter, mostly memory stretching into fiscal 2029 and beyond. And the new Vera Rubin platform is ramping into full production, already running at CoreWeave, Google Cloud, Microsoft Azure, Oracle, and Navius, expected to be about 20% of data center revenue in the third quarter. After the headline print, shares dipped, then recovered to rise almost 5% during and after the call. That swing steadied the broader bet on capital spending by the buyers Nvidia depends on. Concentration is shifting, but still concentrated. Hyperscalers, including Amazon, Google, Microsoft, and Meta, have accounted for roughly half or more of data center in some periods. Frontier labs, including OpenAI, Anthropic, and xAI, are expected to be about a quarter of business next year. Neoclouds combined are headed to about 8 gigawatts of installed Nvidia GPU capacity by year-end from about 3 gigawatts at the end of 2025, with AWS alone adding about 2 million GPUs in 2027 to 2028. Per gigawatt revenue is rising with each generation, and demand is broadening. Valuation was described at about 18 times forward earnings on share prices around 210 DS against rising consensus estimates for the next 12 months, down from more than 30 times at prior highs as earnings have surged. The range moves day to day in the high teens to low 20s depending on the estimate set and whether GAAP or non-GAAP is used. It is pricing Nvidia as an infrastructure toll collector, not a speculative chip stock. Inside the Like and follow for more stories that matter.